Welcome to Validea University. In this series of short videos, we will discuss some key investing concepts that impact investors today and distill them down into their most important components. In today's video, we discuss the basics of systematic value investing. But before we talk about systematic value investing, it is important to define value in general. Value strategies typically fall into three categories. The first is what I like to call Ben Graham value. This group of strategies focuses on buying the cheapest stocks. They can use very different metrics to get there, but the end result is a group of companies that are cheap and out of favor. When we talk about the academic research into value investing, this is the group we're talking about. Most academic work will focus on buying the bottom decile or cheapest 10% of stocks. The second category is Warren Buffett style value. This group combines value with some sort of measure of quality. The goal is not to buy the cheapest stocks, but rather to buy good companies that are trading at a discount to some measure of their intrinsic value, with the hope that the profits these firms make will compound over time. These types of approaches generally end up with more expensive stocks and stray further away from the academic definition of value. The final category is what I like to call Bill Miller value. This style was popularized by Miller in the 90s when he argued that many tech companies were value investments despite the fact that they were very expensive by any traditional value metric. The argument proponents of this type of approach will make is that if you look at companies as the present value of expected future cash flows, then companies with strong projected future growth can be cheap today, even if they trade at high multiples based on things like sales and earnings. These types of strategies stray the furthest from the academic definition of value. Systematic value investing typically looks the most like the Graham style because it is trying to buy the cheapest stocks. But instead of having a portfolio manager make the decision, it does so using a quantitative strategy. Systematic value investing takes advantage of the fact that value investing works on average across a group of stocks, and so it diversifies its bets and bets on value in general instead of individual stocks. It also eliminates the emotion and biases that can often plague human portfolio managers. Although there are many metrics that systematic value investors use, there are 5 major variables that are used most often. The first is the PE ratio. The PE is simply a stock's price divided by its earnings. One thing to keep in mind with the PE ratio is that many different types of earnings can be used. The most common is trailing 12-month earnings, but investors can also use projected future earnings as well as averages of multiple years. The CAPE or cyclically adjusted PE is one example of this that uses 10 years of earnings. The second metric is the price to sales. This is just the stock's price divided by the company's sales. The third is the price to book. This is the price divided by book value, which is assets minus liabilities. This is the most used value metric because it is the most cited in academic research, but it is also the most controversial, since many investors argue that it isn't a good fit for a world dominated by technology and intangible assets. The fourth is price to cash flow, which is just price divided by a firm's cash flows. Some firms use free cash flow as a replacement for cash flow in this ratio. The final metric is EV to EBITDA, which looks at what an acquirer would pay for a company. It divides enterprise value, which is stock plus debt minus cash, by earnings before interest, taxes, depreciation, and amortization. One obvious question that may come up in looking at all these value metrics is which one works best? The answer is a complicated one that we will address in a separate video, but many investors decide not to make that choice and just to use all of them. This is called a value composite. Another thing to keep in mind with systematic value investing is that most practitioners do not just buy cheap stocks. Most employ negative quality screens to try to eliminate firms with things like high debt and declining earnings that can hinder a firm's chances of success. We will discuss negative quality screens in more detail in a future video. Now that we've looked at some of the major considerations in systematic value investing, it is also important to understand why it works. Systematic value investing typically works for 2 reasons. The first is that it takes more risk than the market, and investors receive a higher return as compensation for that risk. Value stocks are typically more volatile than the market due to the uncertainty that exists around their businesses, and that is part of the reason why value works. Value also typically goes through extended periods of underperformance, and investors that can sit through those periods are compensated for doing so. It is also important to understand that the risk of systematic value strategies can vary widely. More concentrated strategies typically have much higher risk, while strategies that hold a lot of stocks or reweight an index like the S&P 500 based on value are usually less risky. The second reason that value works is that it capitalizes on investor behavior and takes advantage of the mispricing created by it. Investors typically overestimate the problems with value stocks and therefore drive their prices down further than is justified. Value investors benefit from this mispricing when the market eventually realizes that things aren't as bad as they seem. This concludes our look at systematic value investing. We appreciate you taking the time to watch the video. To find out more about Validea, you can follow our Validea Vids channel on YouTube. You can also follow us on Twitter at @GuruInvestor. To read our investment commentary, you can go to our blog at blog.validea.com. To take a free trial to our subscription product, which includes the 22 plus factor models we run, you can go to our research website at www.validea.com. Thank you for watching.